This week on Wealth Track, the importance of quality in companies and shareholders. Larry Cunningham explains why he and Warren Buffett are convinced that quality in both improves investment results.
As I studied Berkshire over the years, one of the factors that helps to explain its success is having such a high quality shareholder base. They have given Buffett and the team the long-term runway to execute on their evolving plan.
The importance of becoming a quality shareholder is this week's topic on Consuelo Mack Wealth Track.
Funding provided by Morgan Le Fay Dreams Foundation, Clearbridge Investments, Royce Investment Partners, Matthews Asia, First Eagle Investment Management, and Strategas Asset Management.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. In this era of indexing, where investors buy baskets of stocks, the investors who research and buy individual companies are becoming a rarity. Some would say a throwback to another era. Now, the most obvious example is Warren Buffett, the nonagenarian chairman of Berkshire Hathaway, who is widely considered to be one of the greatest, if not the greatest, American investor in memory. Buffett is famous for buying quality companies for the long term. In his words, forever. He is less well known for his emphasis on seeking high quality shareholders, stock owners who stick around for the long term, which he has succeeded in attracting to Berkshire Hathaway. This week's guest is an authority on Buffett, quality companies, and shareholders. He is Lawrence Cunningham, who hangs his hat as a professor of law at George Washington University. He is also a driving force behind the university's Quality Shareholders Initiative, intended to research and report on high-quality shareholders, as they are dubbed by Buffett, traditional investors that study individual companies, acquire substantial stakes in only a few, and hold them for the long term. He has written over 24 books, including one in collaboration with Buffett, the bestseller, The Essays of Warren Buffett, Lessons for Corporate America, now in its 5th edition, which we discussed with him on a recent Wealth Track. You can see the interview on wealthtrack.com. Among his other books are Berkshire Beyond Buffett, The Enduring Value of Values, and Quality Investing, Owning the Best Companies for the Long Term. His latest book is Quality Shareholders, How the Best Managers Attract and Keep Them. Among Cunningham's many philanthropic activities over the years is his current membership on the board of the Museum of American Finance, the only independent museum in the U.S. devoted to a history of the finance system that made us the world's economic and innovation powerhouse. I have the privilege of being on the museum's board with him. The theme of this week's discussion with Cunningham is quality. First up, from an investor point of view, what does it mean in a company?
Companies that are able to sustain their prosperity indefinitely. So they've got moats, the nickname Buffett created for competitive advantages. So
right.
Buffers that will help deflect technological onslaught or rivals from eroding the durability of the business. That's what we mean when we say a quality company. And it's built for durability, so it's a long-term animal.
Is it possible to still buy companies, I mean, with the exception of Berkshire Hathaway, where the CEO is 90 years old, that you can hold for the long term, that do have sustainable business models? Do those animals still exist?
They do, but you're right to imply that they're rare, and they may be rarer than ever. But if you look back at the Dow 30 at 10, 20, 30, or 40 years ago, it's changed a lot. It changes a lot, and we can expect it to continue to do.
Right.
But there are thousands of companies, and there are quite a few that endure for decades, and that's the sweet spot. That's the cohort that we really very high quality, and they do exist.
Right. Are there a couple of examples of companies that you would say are quality companies that you can invest in the long term, that are sustainable and have a culture and a management philosophy and execution that you can really depend upon?
Unilever might be, I could give you a list of many, but just to highlight one that covers a lot of those bases. Unilever, which is more than a century old consumer products giant operating in more than 100 countries, some of them very, very deep in every consumer product area, soap and paper products and so on. It's got a vast reach around the world, and in those areas it has deep networks of customers, distributors, suppliers, employees, and so it's got a lot of competitive strengths. The power of its brands is also quite impressive, and they invest a lot in advertising and also maintaining the quality of their ingredients so that the products are things that customers value. So
Right.
It's been a very long-term oriented company, and we tell an interesting story in the Quality Investing book, or I think we tell it in the Quality Investing book and the Quality Shareholder book, about how about 15 years ago the markets had begun to focus the company very heavily on its quarterly results, and they were punished when they didn't meet the quarterly guidance. And when that happened several times, managers of the various units decided they needed to pay attention to those market crises, and so they stopped investing in the next new soap or the next new approach to packaging, and instead tried to hit those targets.
Numbers.
Yeah, and this went on for 5 or 6 years before the CEO and the leadership discovered that they were not positioned for the long term anymore. They were hitting some quarterly targets, but they were running out of runway in some areas, and so they went right to the core and stopped offering quarterly guidance. They just told the analysts, we're not going to do it anymore. And at first the analysts didn't like it, and the stock was punished. But after 2 years, it regained a good correlation of price to value, and that value was higher, and it's been sustained for 7 or 8 years since that experiment or that alteration was made. Because one of the problems is that even a great company like that can stumble, or
I was going to say, right.
And, but yet it's able to, and not everyone can course correct, but they did. Another example might be in the luxury goods sector, a company like Hermes that has products with a distinctive provenance.
Cachet.
Yeah,
right.
Cachet, right? And they have very nice materials.
Quality.
Mostly made by hand. People will pay up for that quality. And it's a very well-run company, and so they maintain quality across the chain, across the supply chain and distributions. They're very careful about assuring that they're never supplying too many of these goods. They consciously commit to having that very high quality image in their consumer markets and even in their employee markets. I mean, people like to work at Hermes, and so that company's been around for generations, and I think there's reason to expect that it will be sustainable too.
I mean, those are consumer product companies, a luxury good company, but is it possible to, in industrials, for instance, or in a tech company, is it possible to have, that kind of quality that is enduring and sustainable?
It is. The exact ingredients will differ between a consumer products and an industrial and a tech, but looking for those patterns or those categories is helpful. I'll give you an example in each of those sectors. 3M in the industrial sector, it's an inventor and a producer of a wide range of applications and tools, some consumer, some industrial, and the culture at 3M is experimental research, creativity. Is an intellectual place, and this attracts a high quality sort of researcher, investigator, engineer, and so they're constantly working on new products, new innovations, and then their troops are very good at bringing them to consumers and getting them into
the market,
in the stream of commerce, and there's an example of the moat there is a research-driven culture, and very often a culture like that, while an investigator is trying to solve problem A, they create an invention that solves problem B, and we have plenty of wonderful examples in history of that
Right, of
serendipitous
that.
discovery. It often turns into extraordinary value, and 3M has done it quite a few times. So in tech, I guess the primary example today would be Apple. It shares with 3M that sort of culture of innovation and ideas and constant improvement, really a consumer orientation in terms of the phone and all the apps and everything it's done. And I'm sure it may stumble too. Tech is a very dynamic field, obviously, but at this stage it has such a penetration, and it's not just a market; it's really a culture. Our entire people live by these devices, and they're increasingly useful from every sort of thing. Forget about weather and flashlights. You're going to have all sorts of capabilities that just are added on a fairly regular basis over years, and people will pay up for that too. So I think you can find quality companies in any sector potentially, and at any time in history potentially. And the key is to focus on these features that signal durable economic advantage for the indefinite future.
I mentioned in my introduction to you that another book that you've written that came out in 2020, as a matter of fact, had the word quality in it. There is a theme here. Quality shareholders. This is an interesting concept to me, how the best managers attract and keep them. What is the appeal of a quality shareholder, and what does it mean to be a quality shareholder?
The theme is deliberate, because it's almost as if these are two sides of one coin.
The same,
that is,
yes.
Quality investing is hunting for companies with these durable attributes, and quality shareholders are the people who hunt for them and then buy and hold them for long periods of time. So both long-term focused businesses, long-term focused shareholders, and that's our definition of quality shareholders. And incidentally, I owe the definition to Warren Buffett, who in the 70s announced, as Berkshire was just coming onto the scene, that he wanted to have, he called them high quality shareholders. I've just abbreviated it to quality, and he defined them as being long-term focused owners. And he succeeded in getting them. And that's really what led me to investigate quality shareholders. Was the shareholder base at Berkshire Hathaway is more long-term than probably any other company, or at least it's in the top, and has more concentrated owners rather as opposed to indexers. And as I studied Berkshire over the years, one of the factors that helps to explain its success is having such a high quality shareholder base. They have given Buffett and the team the long-term runway to execute on their evolving plan. They pay attention to the business and not to the stock price. They have very little appetite for short-term quarterly news, quarterly guidance, which Berkshire doesn't issue. And so that led me to study other companies and other shareholders of this sort. And what I produced the results in that book of identifying who the quality shareholders are and which companies they're investing in.
And how potent a force in this day of indexing are long-term shareholders?
The definition of the quality shareholder is a person or a firm that holds for the long term, holds indefinitely in most cases. It doesn't mean they're not allowed to sell. Sometimes it's the right thing to do is sell, but that their preference is to hold forever, and that they focus. And so they pick a relatively small portfolio of stocks, and we're not saying less than 10, but certainly less than 50. And the contrast in each case is with the indexers, who they might be long-term, but they buy every stock in the market.
Sure.
Right, and short-term sort of traders, nanosecond AI type, artificial intelligence type of machine trading on the other, which they might have large positions and might even concentrate in certain degrees, but they're never holding for long. And while the indexers and that transient group contribute something very useful to markets, indexers contribute the market return for millions of people at extremely low cost. And those transients make a market in stocks, which promotes liquidity and efficiency. So they both contribute something, but they've also both been studied extensively. Right? People have focused on the index industry in great detail and have studied, short-termism in probably greater detail. But the cohort that is long-term and focused is underappreciated, but I think
it's smaller now, right? Isn't it much smaller?
Yes, thank you.
It's shrunk.
It's shrunk, right? So our estimate is that the indexers, which includes the avowed indexers, who say we just mimic the S&P, as well as the closet indexers who say they're going to pick stocks, but then they just deliver the market. But that cohort is roughly 30 to 40% of total public equity, depending on how you measure it. And the transient cohort is about the same size. And that leaves quality share, and another cohort are the activists.
Right.
And so that leaves the quality cohort somewhere between 15 and maybe 20%. So it's a small group, and the reason it's indexers have risen and transients have risen while this cohort has shrunk is it's hard to do. It's hard to be long term. It's hard to stay focused. It's easier just to get the market return. But this cohort, what we're discovering is this cohort plays a critical role in valuation. That is, they're the people that do the research that enables trading to find the price, the value of a stock, and on which the indexers free ride, and the transients may do some arbitrage trading around it. But it's this cohort that does the fundamental research that reveals value, or reveals the best estimates of value.
And Larry, you also have a consultancy called the Quality Shareholders Group, where you're advising CEOs in corporate America on how to attract, quality shareholders. And what does it do for them and the performance of the companies that they're running?
Well, one of the most important things is that it gives the managers a runway on which to execute their strategy. So a conscientious manager who has conviction about a particular product development or acquisition strategy or whatever it may be will find this cohort very congenial, very supportive in that regard. And the second thing it's related to that is that this cohort, they're thoughtful and they're students of the business. And so they understand it. They don't understand it as well as the CEO does, obviously, but they understand it way better than the indexers or the transients. And so this is a group, it's a brain trust, or offers a brain trust that CEOs can look to for help. If they're facing a difficult business decision or strategic direction, they can call these people for advice. Some quality shareholders have even served on boards of directors of typically quality companies, and that's the perfect example of this, the union between a quality company and a quality shareholder. When those quality shareholders take a seat on a board, they will also typically buy a significant stake in the company and really become partners. And perhaps the biggest incentive, I guess, to be frank about it in our current environment, is that the quality shareholders serve to validate managerial strategy. And so if an activist becomes restless and presents itself to a board and a company agitating for a new strategic direction, divestitures, recaps, dividends, or what have you, if the CEO also has a cohort of quality shareholders, she can call that cohort and ask, do you agree with the activist thesis, or do you prefer the course we're taking? And very often, by definition, the quality shareholder will agree with the CEO and help that agreement, not always and not inevitably. This brain trust is available then to explain to the activist or to the other shareholders in a public proxy fight why the existing course is the better one.
As far as activist investors are concerned, can they be quality shareholders as well?
Yes, that's an excellent question, and they certainly can be. Because under my definition of long-term and focused, quite a few activists, and Dan Loeb, very often, sometimes Bill Ackman in some of his positions, and others take a very long-term view and take a significant stake and really align. But it's not inevitable, because there are other activists, we call them drive-by activists, who take a small stake and are in it for a short time and cut and run.
So give me a couple of examples where it really has helped the companies themselves possibly fend off what might be a harmful activist attack.
Ashland Chemical was a target of a proxy contest by the activist Cruiser Capital that had proposals for significant changes in operations that management doubted. And so it consulted, the CEO consulted some of its quality shareholders, its large long-term holders, and asked them, do you agree with our current approach, or would you endorse what Cruiser is prescribing? And the quality shareholders studied the alternative proposal, and they knew what the existing course was, and they agreed with the CEO. And a big player in that one was Neuberger Berman, which
sure,
it's a big fund, and they'd owned it for 7 or plus years, and so they knew the company. They're the epitome of a quality shareholder in that setting.
How do you apply this, becoming a quality shareholder to individual investors on the retail level, or does it apply?
It most certainly does. My rough estimate is that of total public equity, the institutions dominate. They have about 70%.
Right.
But still 30% of public equity is owned by individuals. And a lot of Americans still have significant interest in positions in stocks. And my deeply held advice and recommendation is that having a long-term approach is absolutely essential. So I'm very much against the transient approach. I know people do it. The meme stock phenomenon has attracted a lot of people to doing a lot of day trading. They may hold for a few months, but there's a lot of energetic action in the stock market that I don't favor and don't recommend. So on the focus aspect, I agree that the safest thing to do, especially if you don't have the time, energy, or capacity, is to have a significant part of your investment nest egg in an index.
Index fund.
Yeah, it's safer, especially again if you don't have the time or inclination or capacity. But those that have some of any of those, at least a portion, it's fair and rational to invest in just a relatively small number of stocks that you can research, understand, and believe in. I myself, I follow that advice. I've got the 401ks that are in diversified index type funds, and then I have a different part of the nest egg that I invest in particular companies and have held them for decades in most cases and intend to do. The philosophy should appeal and will benefit individual shareholders just as it would institutions. And while they wouldn't participate necessarily in the brain, at least the people like me, the ordinary investors, it wouldn't necessarily. I've been appointed to some positions in that way, but for most of us, we wouldn't be playing that kind of role. But nevertheless, as a group, it does register, does validate the company's viewpoint. So it's a cohort that I also encourage CEOs and boards to cultivate. I think. Having intelligent long-term individual investors as part of the shareholder base can be very beneficial. I think it's especially true when they're also employees. And so I recommend that companies reward their long-term individual shareholders, whether it's through product giveaways or discounts and other perks like that, or even with additional dividends. Give them a 10% higher dividend if they've held the stock for a certain period of time.
Oh, interesting.
Yeah. So I do think I think this is for individual investors as much as for the institutions.
All right. One last question for individual investors, which is for a long-term diversified portfolio, what would you recommend we all own some of? And I'm thinking of the theme of quality companies and quality shareholders.
I'd say an excellent example would be Amphenol. Probably not a household name, but they are one of the leading manufacturers of connectors in the world. These are specialty electrical products that you'll see them in audiovisual equipment and automobile manufacturing. It's just about every industry has some need for their products, and they're regarded as one of the very best manufacturers. Been around a long time in this little niche industry, and I think they'll be around a long time for the future.
Larry Cunningham, thank you so much for joining us on Wealth Track to talk about quality in investing and being a shareholder. It's a fascinating topic. Thanks.
Thank you very much.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is become a quality shareholder. You can make a great start by reading Larry Cunningham's Quality Shareholders, How the Best Managers Attract and Keep Them. According to Robert Hagstrom, author of The Warren Buffett Way, by following Cunningham's prescriptions, companies can improve economic returns and individuals have a roadmap to become quality shareholders and improve their investment results. Having shareholders that stick around has certainly helped Berkshire Hathaway weather many storms, and Buffett would tell you it's helped his results as well. Please feel free to follow us on Facebook, Twitter, and our YouTube channel. Thank you for spending some of your precious time with us. Have a great weekend and make the week ahead a healthy, profitable, and productive one.